Hello, guys, and welcome to another brand new episode of the ITU Forex class. In this week's edition, we're going to be talking about how to use the moving average indicator effectively. So, if you've been trading for any length of time, I'm pretty sure you must have come across the moving average group of indicators, okay? And the reason why they're so popular is because even though they're simple and they're freely available and simple to use, they're actually one of the best indicators which traders who know what they're doing can use to predict low risk high probability or find low risk high probability trading opportunities in the market. Okay, and that's one of the reasons why we're actually doing this class today, because a lot of traders who use them, especially beginners or struggling intermediate traders, don't know how to use them properly. And that's what we're going to address today. And we're also going to be talking about how to use them to maximize your trading performance. Okay. So without any further ado, let's dive right into it. So, first things first, what are the moving averages? And to help you understand what moving averages are, we'd first need to do a little bit of calculations, a little bit of revision to our maths class, okay? So, what in the world is an average? When you hear someone talk about an average, what does it actually mean? So, to give you an example, let's assume that you've got a class of students, and let's say, just for simplicity's sake, that there are actually 5 students in this class. And let's assume that they're taking a subject. Let's just use the English language as a subject here. And so these students take a test, and the overall test score is 100. Okay? The overall test score is 100. Now, each one of these students, since they're part of the class, obviously they took the test, each one of them has a score that he got for that particular test that he took. So for this particular example, we'll say that the first student got an 80, okay? So he actually aced the test, okay? He got an 80. And the second student got 50, okay? The third student, he got a mark of, let's just say 85. The fourth got something like 60. And the fifth, let's say the fifth got 87 or something like that. Okay? So now we've got these 5 students. Now, if you remember from the statistics class you did in mathematics, you know that when we talk about the mean of something, we're actually talking about the average. And so to calculate the mean of this particular student score for this particular test, we're going to need to add up all of these numbers, that's their scores, okay, for each one of the students. And then we're going to divide whatever we get by, that's the sum, divided by 5, because we actually have 5 students who participated in this particular test. So in this example, let me quickly bring out my calculator so that we can do it. Okay, so I think we've got the first student scored 80, the second scored 50, the third scored 85, the fourth scored 60, and the fifth scored 87. Okay, now the sum total of their scores is 362. But to get the mean value, the average value of the test scores, we're going to need to divide this by the number of students who took the test. And in this case, there are 5 students. So the average score, the mean score, is 72.4. Okay, is 72.4. So what does this have to do with anything? What does this have to do with anything? This is the average score for the students who took this test. So the reason why I'm explaining this to you is that I first want you to understand how an average is calculated. Okay? Remember, this is just simple mathematics, nothing complicated here. This is a simple average that is being calculated for the test scores of students. Now, if you wanted to calculate the average of a price, okay, then you're going to need to know what price are you calculating in the first place. And then you follow the same steps we did here to calculate that average, assuming you're not trading with a trading platform and you're doing everything manually. And by the way, you don't need to do any of these calculations manually. I'm just doing them here to make you understand the logic behind these tools that we are using, because the chatting platform that you're using to trade is actually going to do all of this computation all of these computations and calculations is going to do it for you automatically and plot them on your charts. You don't need to worry about any of these calculations. But here we just want to understand the logic behind them. Okay, so assuming you want to calculate the average of a certain price, then you're going to need to, if you are doing it manually, you're going to need to know what price are you actually calculating the average of. And it might surprise you for me to say that what price are you calculating the average of. If this would surprise you if you don't know the anatomy of a candlestick, because if you do know the anatomy of candlestick, you know that a candlestick comprises of 4 components. We've got the opening price, okay, and that's why it's actually called the OHLC. Okay, we've got the opening price, we've got the closing price, we've got the high price of that particular candlestick, and we've got the low price of that candlestick. Okay, so if, for example, you wanted to plot a moving average line of the closing price of a candlestick, then what it's going to be plotted on your chart is the candles that you are seeing, okay, depending on the period of the moving average you are using, then it's going to sum up the closing price of all of those candles, and then it's going to divide them by the number of candles in the calculation. So to make things simple, assuming we are calculating a 100 period moving average, simple moving average of the closing price of this particular chart, what is going to happen is that these particular candlesticks that you're seeing, and let me delete this calculator since we're done with it. Okay, let me pick back this tool. So it's going to actually calculate the last 100 candlesticks on this chart. Okay, the last 100 candlesticks on this chart. Then it's going to find what the closing price of each one of those candlesticks is. Then when it does that, that's the trading platform, it's going to add up the closing price, all of them, and then it will divide that closing price by this number, 100, because we're using a 100 period simple moving average in this example. Okay, so when it does that, it's going to plot the average on your chart. Now, why this happens is because let's assume you're calculating a 100 period moving average and you just started somewhere here. Okay, when it does this, when it actually gets the calculation, what it's going to do is going to add all of this closing price for the last 100 candlesticks and divide them by 100, just like I told you. And then the value that it gets, it's going to add a dot on the chart. And then when another candle closes on this chart, it's going to calculate the value of the last closing 99 closing price and the current candle, and then when it does that calculation and divide it by 100, it's going to get yet another dot on the chart. And so the trading platform is going to automatically be connecting these dots, and that's what ends up looking like a moving average on your chart. Okay, because it does the calculation, and then since there's always, as long as the market is open, there's always a candle that is forming, giving it more new information. That's the moving aspect of the moving average, because as it gets new data, it's going to compute those data together and plot the average on your chart continuously. Okay, so now that we understand how these moving averages are actually calculated, let's move on to the charts and see a practical example of what it looks like. Okay, so here you can see that this is the 4-hour time frame. This is the 4-hour time frame chart of the USD JPY currency pair. And so if we wanted to add a moving average, a 100 period moving average onto the chart, we're going to first click on insert on the menu bar, and then we'll hover the mouse cursor over indicators, and then there you have it. You see the moving average. In case you don't see the moving averages here, because maybe you don't use it all that much, then you'd need to hover your mouse's cursor over the trend category of indicators, and you're going to see moving average here. Once you see that, just click on it, and then here where it says period, it's simply asking you how many candles do you want to use in your calculation of this particular moving average. Okay, so like we used in our example, we used 100 period. So 100 candles, 100 closing prices, if you're using the closing price to calculate it. Okay, and in this case, we're not using anything fancy. It's not an exponential moving average or a smoothed moving average or a linear weighted moving average. We're using a simple moving average. So since this is a simple moving average, which we're using applied to the closing price, we're just in essence adding the closing price of the last 100 candles and then dividing them by 100. And then that's going to continually happen as the trading platform is going to continually connecting the dots on that chart, okay, to show us the average. So once we've done all of this, all you need to do is click on OK. And just like that, you have this line on your chart. So essentially what this is doing is it's calculating the last 100 candlesticks average, and then it's plotting it on your chart like this. So the way traders use moving averages most of the time, the way professional traders use moving averages is they use it to identify whether or not there's a trend in the market. Okay? So for example, if as long as we've just run this moving average on our charts, and then the idea is that if price is trading above its average, okay, then price is basically trading price is basically strengthening in value. It's going bullish, okay? And so the probability that price is going to continue moving up is much higher than the probability that price is going to reverse and change course, okay? And so in situations like this, the low risk probability trade to take will be a long trading position, same as when price was below the moving averages. You can see that when price crossed and closed below this moving average, before it actually switched gears and moved to the upside, it actually went down quite a bit. And so if after seeing this crossover, you took advantage of this weakness in price and sold, you would have made a quite good couple of trades as long as you keep your risk managed. Okay? So the first thing we're going to be talking about here is how traders use them. That is not the right way to use them, especially beginners. You see, because moving averages are mostly used as a tool to identify when there's a trend in the market, you want to actually use moving averages when there's actually a trend in the market. Because guess what? If you're using moving averages when there's no trend in the market, no clear direction in the market, and price is consolidating, then you're going to get stopped out a lot of times by choppy price action. So let me try to find choppy price action and show you an example. Very good. I see we have one here. Okay, so you can see that when I pick this rectangle tool, you can see that the price action we have here is one where price is not moving in a clear direction. Even though it moved from all the way down here and then it moved up, okay? It didn't continue forming higher highs and higher lows, higher highs and higher lows to continue moving up and breaking above resistance and all of that. So you can see that it's almost as if price just kept bouncing in between these levels of horizontal support and resistance. So now, if you were using moving averages to identify the trend in this situation, yes, it might temporarily show you that, okay, price is above its average or price is below its average. But because the trend in the market is not very strong, when you would have maybe taken a buy trade when price crossed above this moving average, you would have been quickly stopped out by a fake out because the trend is not strong. And so price would have easily reversed back below the moving average. And if you had sold when price crossed below this moving average, just because you are selling or buying when price is above or below the moving average, guess what? You would have taken a sell trade here, and then price would have faked you out and hit your stop loss. And so, because price crossed above again, if you had taken a buy trade here, anticipating that price is going to move up, guess what? It moved down again, and you would have been stopped out. So it kept doing this over and over and over again because there's choppy price action in the market. There's no clear defined trend in the market. So rule number one, if you're using moving averages, make sure to use them when there's a clear defined trend in the market. So is there a way for you to spot when there's a clear defined trend in the market? Obviously, if you don't have if you don't have a crystal ball, if you don't have a crystal ball, you can't know this. And this is where risk management comes in. Because the idea is you don't need to know which breakout or fake out or cross above the moving average or below it is going to be a cross backed by real momentum and a strong trend. You don't know that because you don't know the future. I don't know that because I don't know the future. But what we can do to actually improve our trading performance is for us to practice proper risk management so that for the times when we are wrong, when price crosses above a moving average or below a moving average, and then there's no strong trend to back that crossover, the losses that we're going to take are going to be very small. So that during the times when we keep trading, we're actually taking small losses and protecting our capital and making ourselves available for the time when price is going to cross either above or below the moving average and be backed by a very strong trend. And in such situations, the profits that we'll eventually make from the market when that happens will be more than enough to cover for these small losses that we would have taken when there's choppy price action in the market. Okay, I hope this clears the point. Okay, so if you notice that there's a choppy price action in the market, then moving averages are not what you would want to use to identify low risk, high probability trading opportunities during those time periods, because they don't work. They don't play friendly with times when there's no clear trend in the market, no strong defined trend in the market. Okay, moving forward. The second way that traders use moving averages is to use their crossover to identify trade setups, trade entry opportunities, or trade exit opportunities. So to elaborate this, to show you practically what I'm talking about, this moving average that we added to the chart, if you remember, this is a 100 simple period moving average applied to closing price of this particular trading instrument. Okay, so if we wanted to use a moving average crossover, one popular moving average crossover strategy that is used is for you to use the 50 period moving average along with the 100 period moving average. So for this, let's just quickly change this line. Since it's the slower moving average, let's change it to red. And then we're going to add one more simple moving average. Not that the change in color means anything. It's just preference for me at this point, okay? So the second moving average will be a 50 period moving average applied to prices close, okay? So this simply means that it's calculating the closing price of the past 50 candles and then plotting the average on the chart. Okay, so now if you take a close look at what we have on the charts here, you notice that whenever the fast moving average, which is the black one in this example, whenever it crosses above the slow one, let me see if I can pick this tool here to show you, or let me just use this, the crosshair. Whenever it crosses below the slow moving average, we've got a signal for a short trade. And so you could take a short trade here, because this is telling you that since the fast moving average crossed below the slow one, the momentum is probably to the downside. So if after seeing this crossover, you took a short trade, this would have been somewhere around here that you would have taken the trade. And let's assume that whenever you take a trade like this is a simple strategy, okay? And just like any other strategy, it doesn't win 100% of the trades it generates. But hopefully the profits that is going to make you from your winning trade setups will be more than enough to cover for the losses, the small losses that you take from your losing trade setups, okay? So for this particular example, you can see that if you had entered a trade somewhere around here when the crossover occurred, and then you held on to that trade and didn't take any other trade until this black moving average crossed above the slow one, then you would have closed your sell trade somewhere around here. And you would have been profitable because you would have entered here, closed somewhere around here when the crossover occurred, and you would have made a little bit of profit from this trade here. And also, since the black moving average, which is the fast moving average in this case, crossed above the slow one, which is the red one, you would have taken a buy trade here, and you would have still been in this buy trade. So you would have entered long somewhere around here, and you can see that price is way above somewhere here. Okay, this is just one example or two examples here. Let's go way back in time so that we can see more examples. Very good. This is a beautiful example of this moving average crossover strategy. So you can see that this black moving average crossed below the slow one, okay, the red one. And you would have taken a short trade here because this is telling you that the momentum is to the downside. So if you had taken a sell trade somewhere around here, okay, when the crossover occurred and held on to that trade, you would not have closed the trade up until when price came all the way down here to make this crossover. Now for this particular trade setup, just look at the number of pips you would have made in profits. Okay, just look, you would have entered somewhere around here when the crossover happened, and you would have held on to this trade all the while until the second crossover happened somewhere around here. So this just this single trade, you would have made a profit of almost 600 and something pips. Okay, so this moving average crossover method, it does work. But the problem is that a lot of inexperienced traders or struggling traders, they find it difficult to sit on their hands and wait for the strategy to develop a trading signal for them to take And when that even happens and they take that trading signal, for them to sit and do nothing while they hold on to a profitable trade like this or a losing trade or whatever is the difficult part, because they also can't do that. They don't have the patience to do that. Okay. And trading, like I tell you, is not a game where you just keep chasing for the quick wins or all of that. It doesn't, without proper risk management, even if you're given a trading strategy that wins 90% of the time, trust me, you're still going to find it difficult to make money. Okay, so just because I showed you this example of a strategy of a trade that brought in a profit of around 600 pips, does this mean that the strategy wins 100% of the time? Of course not. Of course not. And you can see that we had a setup somewhere around here. You would have taken a buy trade here, and then you would have closed that buy trade somewhere around here where you took that short. But these are all giving you small profits and small losses. So if you remain true to the game, and in fact, with that in mind, you can see that this particular trade setup would have been a losing trade, because you would have entered after the crossover somewhere around here, and then you would have only closed the trade when price crossed, when the moving average crossed above this, somewhere around here. So you would have entered here, a short trade, and exited somewhere around here. And this would have given you a small loss here. And this is exactly why I told you that you're not going to win 100% of the trades you take, but you don't need to, because if you trade with proper risk management and you make sure that the wins from your winning trade, the profits from your winning trades are huge, more than enough to cover for the losses, the small losses from your losing trades, then eventually, even if you lose 60% of the time, the profits from your winning trade will be more than enough to make you profitable. And that said, you can see we have another example here where price crossed above the moving average. The black moving average, the fast one, crossed above the slow one, giving you a long trade signal somewhere around here. And you can see you would have not closed this trade up until when price made this bearish crossover somewhere around here. So this trade would have also given you a profit of around 600 pips. Okay, so you can see your losses are small in comparison with the profits that, those winning trades would have given you when the market was moving, when it was trending. But there's going to come a point in time when you're using the problem with this trading strategy is there's going to come a point in time when you're using it and then the market is not trending. There's choppy price action. And when that choppy price action occurs, you're going to notice that price is just going to keep, moving up and down, and the moving average is just going to keep making false crossovers and all of that. And you're going to take a lot of small losses. So during those time periods, you need to know that your trading strategy has an edge. When the market begins to trend, it's going to work out in your favor and give you profits. But if you don't stick to the game, don't stick to those periods when you take those losing trades, you cannot expect to catch those winning trades when the market begins to trend. Because let's say you take 4 or 5 losing trades in a row when the market was choppy, and you decide not to take a trade because the market is obviously choppy. You're scared of taking another trade which will turn out to be a losing trade. And then all of a sudden, that trade that you didn't take was the one when the market resumes a trend and keeps moving in the direction of the trend to make maybe something like 600 or 1,000 pips, just like the examples I'm showing you here. Then you're going to miss out on that trade. And that single winning trade would have been the trade which would have covered for all of your losses and give you extra profits in the process. So you need to, even though the strategy that you are using to trade is going to have losing trades and all of that, you need to have that mental fortitude to know that even though you're taking losses, eventually if you stick to the plan and you trade with the strategy, the profits from your winning trades are going to be more than enough to cover for the losses from your losing trades. Okay, trading, like I keep telling you guys, is just a numbers game at the end of the day. There's no strategy out there except if you can know the future, which I'm probably sure that you can't. There's no strategy that is going to give you a 100% winning trades. Okay, so because that is not a possibility, you need to work around it. And the only way to do that is by using proper risk management, where you ensure that you always cut your losses short and let your profits run. Or in the bare minimum, let your profits give you enough profits to cover for the losses from your losing trades. Okay? As you can see, we've looked at a couple of examples of very, very profitable winning trades. You can see this is another example of a winning trade here based on this simple crossover trading strategy. So this black moving average crossed below the fast one, okay, the slow one, sorry, the red one, and you would have seen a short trading signal setup somewhere around here. Now, if you had taken this trade and you held on to the trade, you didn't close the trade up until we had the next crossover somewhere around here. But just this single trade, just this single trade would have been more than enough to give you a profit of around 13,000. Yeah, okay, sorry, 1,300 pips. Bear in mind that this is the 4 hour time frame. So if you are taking this trade, you would have held on to the trade for weeks or even months at a time. Okay, so if you're not, the type of trader that likes to trade, swing trading strategies, then this time frame might not be for you. But this doesn't mean that you can't use the moving average crossover technique, because you can also use them on lower time frames. You can see I just moved to the 5 minutes time frame, and this is a crossover signal that we have somewhere around here. So if you are taking the trade when this crossover happened on the 5 minutes time frame, and you held on to that trade up until when we had the next crossover, this trade would have easily given you a profit of around close to 100 pips, and in fact, yes, close to 100 pips. So it doesn't matter which time frame you're using. You just need to know what type of trader you are and which type of trading style fits you. Is it swing trading? Is it scalping? Is it day trading? Whatever the case might be, use it and then backtest the trading strategy before you use it live. So when you backtest it on historical data, you're going to prove to yourself whether or not that trading strategy has an edge in the market before you deploy it on live funds. Because when there's money at stake, then all reason tends to go out the window, especially if you're trading with the trading strategy that you don't have data to back. Okay, so this pretty much brings us to the end of this week's edition of the ITU Forex class. But before we wrap up, I'd like to use this opportunity to introduce you guys once again to our ITU suite of bots, which are designed to help you earn while you learn how to trade. Okay, so we've got the ABT, the SBT, the ITU Gold Mine, and the ITU Gold Mine Pro, which are all bots which are designed to look for low risk, high probability trading opportunities on your behalf and actually place those trades, manage those trades with proper risk management, and help you to capitalize on the markets with proper risk management if you follow our risk recommendations, obviously. So if you're interested in setting it up, please reach out to us on the socials or drop a comment in the comment section here, and we would be more than happy to assist you, show you step by step how to set everything up and start earning while you're learning how to trade. So if you're interested in that, please reach out to us on the socials and we'll do the needful, okay? Once again, I look forward to seeing you guys in next week's edition of the IT Forex class, and I sincerely hope that you've gotten a ton of value in this week's edition. Once again, thank you for making time out of your busy schedules to come to the class, and I look forward to seeing you guys in next week's edition. Thank you, and God bless you all.